Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. Oh hell, headache time once again. I really must apologise again for the multitude of lines and labels that I've drawn in this daily chart. However, technically there's still a lot going on here, and these lines and labels are all valid to my deciphering, trying to decipher what is happening here. Okay, instead of giving a huge history on this, I will instead talk about the action from the peak in April and reference earlier pieces as I deem necessary. The market's rise in April rose up to the neckline of the August to November 21 complex triple top, currently 2039, breaching it, breaking it even before the rally failed in mid-April, and we've seen prices drop after this, even gapping lower until mid-May. Now please keep in mind that neckline of the August to November 21 complex triple top as it pops up again later. Anyway, the massive congestion support around the middle tine of December 2020 to April 21 bullish shift pitchfork, currently at 1911, mainly the combination of the February 21 high 1894, the medium moving average currently 1904, the long moving average currently 1916, the short medium moving average currently 1935, eroded the bearishness over the start of May until the middle of the month, such that though prices pushed below all of them, the market did not have the energy or further impetus to aggressively push even lower. For instance, below the congestion from February this year between approximately 1840 and 18 even. Within this congestion, notably sits the 50% absolute Fibonacci line for the 21st century at 1809. Thus, on the 12th of May, the market made an immediate countering bullish engulfing pattern. That was the start of a strong, quick move higher, which halted a few days later on the 17th of May by our old friend, the neckline of the August to November 2021 complex triple top, aided and abetted by an area of resistance that currently stretches from 2010 up to 2100. This is not a new area, no. You can see a box to the upper left of the daily chart that I wrote. Well, I can't seem to remember when I wrote it, but it details a specific band from January to February 2017. Just on this daily chart, this area has capped the market back in October and November 2021, and then again recently in April and May this year. All this action also created, some may say artificially, an island bottom over the first 2 weeks of May. The target for the island bottom was reached on the top side in the move higher. So for all this action, where has that left us apart from confused? Well, apart from the middle tine of the big December 2020 to April 21 bullish shift pitchfork, there are two competing influences on this market. Because of so many lines I've decided to do a first and color code them: green for bullish and red for bearish influences, bullish influences. Firstly, the bullish influence, and the one that is currently under attack, is the lower tine, currently 1860, of the start of March to mid-May bullish shift pitchfork. To be honest, this one looks pretty weak, and I wouldn't be surprised if it is retired next time. The bearish influence is in red, and it is the mid-April to mid-May bearish shift pitchfork, with the key tines being the middle tine overhead, currently 1897, and the lower tine below, currently 1799. The key levels below are the 21st century 50% absolute Fibonacci, I already mentioned that, at 1809, and the lower tines of both pitchforks. The other thing to watch out for, and this will depend on the durability of the bullish shift pitchfork, is when the tines cross over. The first crossover is on the 29th of June. The second is on the 4th of, let me just check that, it is on the 4th of, 28th of June is the first one, and that's the second one, it's the 19th, there we go. Let's call it 14th. Yeah, 14th of July. So I've got that right. It's on the 14th of July. If the green bullish shift pitchfork is still valid, of course. Now, those are the three levels to watch for: the tine crossovers and the three lower tines. The time crossovers, they'll be suspect, I suspect, because of significant inflection points where we may see volatility, potentially a change in trend, or potentially a reinforcement of a trend. I'm not certain at the moment because there is just so much noise in this message. But those are levels to watch out for and dates to watch out for going forward. Ice Europe, white sugar in London. Okay, so let's cover some of the groundwork. You see, this market made a big meal from the break upwards out the September 21 to February 22 lopsided diamond pattern back in February. The move up took its own time, but by mid-April, the market reached up to the 572.20 area, the target for the mid-February, mid-April bullish halfway hesitation. Since then, we've had a changeover gap lower the market levels, and prices have pulled back to the vicinity of the congestion from early 2017 in the 517.80 area. This area is actually a complex support zone, as it also includes the neckline from the August to December 21 complex head and shoulders top, currently 527.60, as well as the important rising medium moving average, currently 532.5, and the rising long moving average, currently 518.30. This is why, back over late April and early May, prices held over and around the 517.80 area, more or less, and under the old gap from March 2017 between 531.70 to 532.70. In mid-May, I posed the question, what does this period of intraday indecision, what does it signify? Does it signify a bottom, with prices moving back up to the May 2017 high resistance at 548.70? Or does it signify a halfway hesitation, with prices tripping down below all the moving averages, as well as the congestion area 488.10 and 490.10? The answer came during that same week when the market made a weekly key reversal up, which included a gapping move higher after some stabilization over the March 2017 high of 548.70. The market started to be corralled on the top side, for the most part by the middle time, currently 588.40, of the then newly drawn February to May bullish Andrews pitchfork. 4 weeks ago, the market made an unusual key reversal up on a prior bullish pattern that pushed prices up over the next resistance, the February 2017 high of 565 even, thus filling in the changeover gap between 554 even and 572.5. 3 weeks ago, with another key reversal up, this time it was an immediate countering key reversal up and bullish engulfing pattern, the market pushed up over the next resistance level of 575 even, as well as the middle time, and into banded resistance starting at 587.10 all the way up to 608.30, and including the November 2016 high at 590 even and the October 2016 high at 608.30. This overhead congestion was too much for the bullish incentive, and 2 weeks ago the market made a weekly key reversal down in response. Last week the market went through a period of indecision, caught between roughly 555 even below and 570 above. And this is where we are, between the middle time above and the lower time below, currently 543 even. Is this recent action a bearish halfway hesitation or a base building action for a potential move higher? Well, it is too early to know right now, especially as last week had 3 out of 5 days as indecisive spinning tops. Sugar white premium spread. A second weekly indecisive spinning top in a row last week, as the market, after reaching target X last week at 162 even, has decided this past week to sit and try and figure out what to do next. The key pattern in recent times has been the eventually bullish ascending wedge pattern formed between June last year and March this year. The market finally made sense of the false break higher, then lower, then back up again from this ascending wedge pattern. It was actually a reasonably good looking pattern. I would not normally expect problems from such a pattern. However, problems are what started to happen when prices reached the final part of the pattern. It's only the weekly key reversal up made 6 weeks ago that finally decided the matter. There are 2 further patterns, one of which I'd previously drawn your attention to, which I would like to discuss. The first is the quiet and subtle bullish bow tie formation formed over Christmas last year, made up from the short moving average, currently 149 1/4, the short medium moving average, currently 123 3/4, and the long moving average, currently 187 1/2. What had been interesting back at the time of its formation was how all the moving averages went in and out of the bow tie in the right order, a rare feat in some markets. Theoretically, the market should move in the direction of the outgoing moving averages, in this case higher, which we have already seen happen. However, the key move should happen between 15 to 20 trading sessions after the crossover. In this case, it would be between the weeks of the 4th of April and the 9th of May this year, which is when we saw the previously mentioned weekly key reversal up. Thus, a good pattern for the upside. The second key discussion point I'd already pointed or spoken about over the last few weeks. What is important is that it may be indicative of the future bullish angle of attack of this market. It is the 2019 to 2021 bullish Andrews pitchfork. The market is currently between the middle time below, currently at 137 3/4, and the upper time above, currently 212 even. This bullish Andrews pitchfork is still operational. Overhead, we now have the next resistance level, the 2013 high at 152 3/4, which is still live as we have not had a single weekly close over it as yet. There's a tiny quarter cap. Next is a congestion zone from about 164 3/4 up to the 178 1/2 area, and which starts with a gap from the July and 2012 high at 164 3/4 to the low pre-changeover in June 2011 at 167 1/2. Prices 2 weeks ago managed to get up as far as 167 1/4, but did not completely fill that gap, as I just mentioned, despite reaching target X in the 162 even area. A secondary harder to achieve target X1 for this ascending wedge pattern is even higher in the 191 1/2 area and just off the top of my daily chart. I added a few weeks ago, and I quote, "I know these are humongously big asks. That is what I see, but that is what I see. It depends on one thing and one thing only, that prices maintain contact with the middle time or break upwards clear of it." End of quote. Well, so far prices have broken up through the middle time and have seemingly consolidated at higher levels. We now wait and see what the market will make of the overhead congestion zone, if the harder to get target X1 is achievable. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investors International Limited. And here comes the final bit.